the debt refi cycle comes towards the back end of this year, 2024, 2025. So I think we'll see monetary printing, a cutting of rates coming over that period of time. The monetary printing will be brought forward if the banking crisis comes back again. My view is there's a potential that later this month we start to see some cracks appearing there again, and that narrative comes back. Maybe it doesn't. We'll wait and see. It's not my core thesis, but it's something that I'm observing that would bring back the money printer goes burr, or more cowbell, as I say, a bit faster.
Former Bank of England Governor Mervyn King has issued a stern warning that excessively raising interest rates could potentially push the UK into a recession. Lord King's critique comes just ahead of a scheduled meeting of bank officials tasked with deciding the next course of action for interest rates. Reflecting on signals from credit markets in 2021, which had initially suggested an impending surge in inflation, King now points out that these indicators are indicating a sharp decline in price growth. Market expectations indicate a potential increase in the base rate from the current 5% level. However, King asserts that the Monetary Policy Committee officials could risk tightening monetary policy excessively, leading to a recession if they pursue further rate hikes. He criticizes the central bank for overlooking signals from money supply data that had hinted at higher post-pandemic inflation. The bank, in its defense, claims that it had delayed taking action to curb inflation in order to prevent the economy from undergoing a period of weak growth and heightened unemployment after the conclusion of the furlough scheme. Raoul Pal delves into these insights comprehensively in his video, shedding light on macroeconomic developments that suggest imminent changes. He discusses the potential implications of rate hikes on various economic indicators and advocates for technology and cryptocurrency investments as attractive options in the current landscape.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Where are we? This is the most hated rally I've ever seen, and I've seen some hated rallies. 2009 was another classic. It is my view that last year, when the NASDAQ, S&P, the bond market, commodities, everything collapsed, that was the pricing in of the recession by those. And I do enormous amounts of work. We probably have 1,500 charts, plus a macro model, plus a bunch of stuff with Global Macro Investor, where we look into this. We saw from our forward-looking indicators what was going to happen. And we also then have been expecting the lagged effect of the economy to come through. We also noted that markets were somewhat forward-looking and that they would start rallying once liquidity started coming in, which is part of the everything code. We'll go a little bit through the everything code. And so that has exactly been playing out. We were buyers of Ethereum back in June, thinking that the global liquidity cycle had bottomed, and ETH was the leader of the entire cycle. That bottomed in June, did not bottom again in October, while everything else bottomed in October. I remember putting out some tweets for people talking about it's usually the bear killer month. Usually get a bear market and it usually dies in October. And that's what happened as liquidity came into the market. So that got me very constructive and bullish, first on crypto, because that's my chosen asset allocation. We'll come on to that later, because I think it's the fastest horse in the race. The race is all about debasement, which is the everything code. It's not about liquidity that a lot of people talk about on Twitter. I'm less interested in that. I'm interested in the debasement of global currency by the world's central banks. Liquidity is a factor, obviously, within all of this, and that comes up and down with the business cycle. And we'll come on to the debasement cycle later. So by January, February, I've been buying everything from NASDAQ to Microsoft to Tesla to Coinbase to KR1 in the UK to a whole bunch of these semiconductors over time, just buying all of these things on my thesis that the exponential age in technology. So I bought crypto first, then technology. Crypto is by far the biggest bet. Technology was going to be the second fastest horse. Now, what's proven out so far this year, I can blow my own trumpet for a little bit for once, because I get so much abuse anyway, is so if I look at Solana, which is one of my bets, it's up 170% this year. Bitcoin's up 81%, ETH's up 60%. Meanwhile, over in the exponential age in equity land, that's up 73% this year, and NASDAQ's up 45%. And we said that, the other horses to back weren't worth backing. S&P's up 18%, so the NASDAQ's done 2.5x what the S&P's done. So the thesis seems to be playing out. I think that continues into 2026. So I still see a lot of people expecting the second bear leg lower. I don't think that's coming. Of course, we'll get corrections. We'll probably get a scare along the way too, where everybody thinks the world's going to end. But I don't see anything but an ongoing forward-looking liquidity cycle and business cycle. The business cycle to me is bottoming in the next month or two, and that will start moving higher. But that phase of the business cycle is the sweet, sweet magic. When the economy starts recovering, asset prices start booming, and inflation, which is lagging, continues lower. The Fed, I think, are purposely raising rates late into the cycle because they want inflation as low as possible so they can cut rates as low as possible when it comes to the debt refi cycle. You've all heard me talk about this and if you don't, go and look at the stuff on the Everything Code on YouTube or on the platform where it's in much more detail. But the debt refi cycle comes towards the back end of this year, 2024, 2025. So I think we'll see monetary printing, a cutting of rates coming over that period of time. The monetary printing will be brought forward if the banking crisis comes back again. My view is there's a potential that later this month we start to see some cracks appearing there again.
Economists are claiming to have accurately predicted the significant surge in inflation that exceeded 10% in 2022. They are now cautioning that a reduction in the money supply available to consumers and businesses, following 13 consecutive interest rate hikes, could lead to a swift reversal of inflation without requiring further intervention. According to Raoul Pal, there is a notable risk that after previously overlooking the role of money when inflation was on the rise, authorities are now failing to consider its significance as inflation is poised to decline. This situation presents the potential for mistakes to be made in both directions over a span of 3 to 4 years. If the current trend of tightening monetary policy continues for the next 6 months or so, there is a possibility that it could inadvertently trigger both a recession and a sharp decrease in inflation.
The forward-looking indicators are suggesting all of this goes up from here onwards. My view is that we will see, as I said, rate cuts to come. The Fed are purposefully late because they need to get all inflation expectations crushed. The one-year break-evens are already, so that's the expectation of inflation 1 year in advance, already about 1.3%. So it's come right down. The true inflation gauge of current inflation is about 2.1% this morning. I think we break through 2% in the coming month and on our way to zero. So I think forward-looking inflation is zero. PPI is zero. PPI across Europe is negative. PPI in China is negative. PPI leads CPI. CPI is going to head lower. And of all of you going, yeah, but what about wages and what about rents and core sticky? It's always lagged. It is every single time lagged. It's purposely lagged, just the definition of how these things work. So we are seeing already forward-looking indicators of rents coming down. The core CPI is mainly driven by that. That's what the services inflation is. Wages are already deflating, starting to come lower, and we will see ongoing deflation from that. Core CPI, wherever it settles down at, will be amenable to rates being back what they need to be, which is at or below trend rate of GDP growth. Again, part of the Everything Code, which I think trend rate of GDP growth in the United States is 1.75%. So it's kind of all to play for here. Early cycle, this is the spring, the macro spring. We call it the GMI spring, that quadrant where growth stocks take off, all the growthy stuff happens, inflation is falling, unemployment's falling, and growth is basing and starting to pick up. We will see that the forward-looking indicators, even the ISM, the simple stuff like the ISM new orders index, those kind of things, inventories and new orders are starting to pick up. It's all over the place. And look, the Fed know it. They're not stupid. They know that the cycle turned a long time ago. They know the forward-looking indicators, where they are. They know inflation lags. But as I said, really for them, it's to undershoot inflation. That's now my core view is they want to undershoot because it gives them the excuse to fire the bullets that they want to fire. Unemployment will rise. It won't rise as much as other cycles because structurally there are just less people in the labor force. And so there's so many retirees. When you look at aggregate total economy, it's a very different picture. So I think unemployment rises 1.5%, and inflation continues lower. That's a very supportive backdrop. More cowbell, more printing to cover the interest payments on the debts that they're rolling forward according to the Everything Code cycle. So I remain incredibly constructive, really constructive tech. We've also got the narrative of exponential age, which is an astonishingly powerful narrative. around all of these, the adoption of all of these technologies all at the same time. Everything from AI to cryptocurrency to robotics to self-driving cars, which is AI and robotics added together, Internet of Things, which is basically robotics and AI again. You can see how these all interlink, right? Genetic sciences, which is AI and big data itself, green energy, all of this stuff is all going exponential at the same time and is not going to stop for the rest of our lifetimes. So get used to a pace of change of which we can't understand, but also it also means that it will drive asset prices significantly. We will have booms and busts. By the rate of change of the NASDAQ, I think the NASDAQ goes a lot higher. The Everything Code gives forecasts out to 26, which I will not give out publicly. It goes a lot higher. Will we end up in a bubble? Potentially. Depends how big the narrative builds, how big the meme builds around AI and exponential age technologies. So lots to play for. Early days. That wraps into crypto. Crypto is my chosen horse. It outperforms everything in this type of cycle. Like technology, it's driven by debasement of the central banks, of the fiat currency market, particularly the world's reserve currency of the dollar, but all of them together, really. And in addition, it's driven by the secular trend. The adoption trend of crypto is huge. It's now 425 million wallets. It keeps going up every single year. Even last year in a bear market, it grew 40%.
Turkey's central bank enacted a 250 basis point increase in its key interest rate, reaching 17.5%, a move falling short of anticipated 500 basis points. The aim is to address double-digit inflation, with the bank emphasizing a gradual and timely approach to further strengthening monetary tightening until significant improvement in the inflation outlook is achieved. Meanwhile, Japan experienced accelerated consumer price growth in July, marking the 15th consecutive month of core consumer inflation surpassing the central bank's target. The Bank of Japan is anticipated to maintain its benchmark rate of -0.1%, and while Japan's inflation is at a 4-decade high, its unique policy approach has yielded mixed results in stimulating the economy. This economic landscape prompts discussions about potential bank crises, and opinions on this matter are welcomed in the comments section. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.